What's up everyone, my name is Joris, welcome back to my finance channel. Today a last minute news flash. The Fed spoke yesterday and their speeches might have big consequences on the stock markets. We'll look at them right now. The Federal Reserve Chairman Jerome Powell has just announced that the American Central Bank is likely to begin withdrawing some of its tapering policies before the end of the year, though he still sees interest rates hike off in the distance. He claims the economy has reached a point where it no longer needs much policy support, and by the end of 2021 the Fed will most likely begin cutting the amount of bonds they are buying each month. At least if this economic progress stays strong. At this moment, the Fed is buying a minimum of $120 billion worth of bonds every month to support the economy. And of course, indirectly the stock and bond market. By now, the Fed's balance sheet is at nearly $8.4 trillion, around double of its levels of March 2020. This huge financial support also presses down interest rates, reaching unprecedented low levels. However, stopping the tapering by the end of this year does not mean that the rate increasing are looming. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we already have articulated a different and substantially more stringent test. Powell said this in preparation remarks for the virtual summit. He noted that the current inflation levels hover around the Fed's target rate of 2%, and his main concern is the maximum employment at the moment. As long as this employment rate stays low, inflation rates won't spike. At the moment, inflation rates are pushed up by a select few products. Products like oil crashed last year, and their recovery is one of the reasons why inflation is as high as it is today. But these prices are stagnating again and they are reaching healthy levels. Other products like second-hand cars are also stabilizing, so now the supply chains are again being set up. It is highly unlikely that those few products will continue to push inflation upwards. As said before, the employment rates are also on the rise again. But we are definitely not there yet. We are definitely not in a saturated market for the employment. Still today, a lot of people are unemployed and they remain unemployed, and more vacancies are being posted online. Last year, during the Jackson Hole Summit, Powell committed to full and inclusive employment, even if it meant allowing inflation to run hot for a while. Critics have blamed this policy for the current high inflation prices, obviously. However, I'm sure that Powell and the Fed don't make ill-timed policy moves in response to economic or temporary economic gyrations like the current move in inflation. Powell states that today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake, the ill-timed policy move, could be particularly harmful. We know that extended periods of unemployment can mean lasting harm to workers and to the productive capacity of the economy. The unemployment rate for July stood at 5.4%, down from 14.8% in April 2020, but it is still quite high if you compare it pre-pandemic. In February 2020, unemployment was 3.5% and there were 6 million more Americans working. According to the Fed, the Delta variant of the COVID presents a near-term risk to get back to full employment. People don't want to get back to work, but due to the worldwide vaccination programs and the visible amelioration, there is hope. The prospects are good for continued progress towards maximum employment. Inflation at these levels is, of course, a cause of concern, but that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. So all in all, the current inflation levels are high, but the Fed doesn't expect them to remain high. All in all, at the end of the year, the Fed will reduce its financial support plan, but by then the inflation levels would have gone down anyway. So for the stock market, we don't expect any major jumps down or up. And we'll see how it goes. I'm not concerned about the stock market. The economy is gaining traction again and financial support should be stopped when possible. So all in all, the investment advice stays the same. You just keep investing, you don't panic, and you'll just see what happens. If you want to see more of these last minute news videos, subscribe to the channel. Also like this video for the YouTube algorithm. I thank you very much for watching and I will see you in the next video.